Ever feel like the stock market is just a casino for people in suits? You see headlines about buying the dip, or friends talking about their Tesla or Nvidia gains, and you wonder, what are they actually buying? Today, we are stripping away the Wall Street jargon. We're going to cover exactly what a stock is, why companies offer them, the difference between common and preferred shares, and most importantly, how you can use this mechanism to build wealth. This isn't just about definitions. It's about understanding the engine of the global economy. By the end of this video, you won't just know what a stock is. You'll understand how to participate in the growth of the world's most successful businesses. Part 1. The cake, analogy, and the reality of ownership. Let's start with the basics. A stock is simple. It is equity. When you hold a share, you are a part owner of a corporation. Think of a massive billion-dollar company like a giant chocolate cake. The company splits that cake into millions of tiny slices. Each slice is a share. If you buy one share, you own that slice. If the company makes a profit, you own a piece of that profit. If the company's brand becomes more valuable, your slice becomes more valuable. Why do companies do this? This is the IPO, initial public offering phase. It's expensive to build factories or develop AI. Instead of taking a bank loan and paying interest, companies sell ownership. They get the cash. You get the potential for future growth. It's a win-win if the company succeeds. Part 2. The Fresh Kicks story. Let's make it real. Imagine Fresh Kicks, a local sneaker shop. Maya needs $100K to scale. She sells 10 shares for $10K each. The upside: if she opens 50 stores and the company value hits $1 million, your initial $10K investment is now worth $100K. That's a 10x return. The downside: if the market shifts to online-only retailers and Maya's business struggles, that company value drops to $50K. Your 10K share is now worth $5K. This is the fundamental risk-reward ratio of the stock market. You aren't gambling on a number. You are betting on the success of a business model. Part 3. Common versus preferred. The hidden perks: most beginners only know common stock. But there's a secret layer. 1. Common stock. This is the growth play. You get voting rights. You help choose the board of directors. If the company hits a home run, your stock can go to the moon, but you're the last to be paid if things go south. 2. Preferred stock. This is the income play. You usually don't get a vote, but you get priority. You get your dividends first, and those dividends are usually fixed. It's safer, but it rarely produces the 100% annual gains that a breakout common stock might. It's the middle ground between a stock and a bond. Part 4. The marketplace. You don't need to go to the NYSE floor in New York. Today, the marketplace is in your pocket. Explain the role of brokerages: Fidelity, Robinhood, Schwab. Talk about the concept of going public. When a company lists on the NASDAQ or NYSE, they are essentially saying, "We are ready for the world to own us." This liquidity is key. Unlike owning a piece of a private bakery, if you own a stock, you can click sell and have cash in your account in days. That liquidity has immense value. Part 5. Strategy: how to actually invest. So you're ready. Do you buy one company? No. That's like betting your whole life savings on a single horse. Diversification. This is the golden rule. We talk about index funds, buying the whole market instead of trying to pick the best slice. The long term: the bank gives you 1 to 2% interest. The market has historically returned 7 to 10% over decades. That compounding is how ordinary people become wealthy. Final advice: don't put all your eggs in one basket. Research what you buy. Don't chase headlines. Build a portfolio that you can hold for 10 or 20 years. Conclusion: stocks aren't magic. They are businesses. And when you invest in a business, you are participating in its growth. If you found this breakdown helpful, please hit that like button. It helps the algorithm show this to others who are just starting their financial journey. Comment below, if you could own a piece of any company in the world, which one would it be and why? Let's talk about it. See you in the next one.